The Minority Market. Episode 21. Valuation Thinking Explained Simply. Valuation is one of the most misunderstood concepts in the stock market. Beginners either avoid it completely, thinking it is too complex, or misuse it by relying on single ratios without understanding context. Many believe valuation is about finding the right price or predicting exact future returns. In reality, valuation is not precision, it is probability. Thinking like the minority means using valuation as a tool for risk control, expectation setting, and decision clarity, not prediction. At its core, valuation answers a simple question. What am I paying today for what I am likely to receive in the future? This future is uncertain. No model can predict it accurately. The mistake most people make is assuming valuation is about accuracy. It is not. It is about margin of safety. It helps you understand whether expectations are already too optimistic, too pessimistic, or reasonable. Let's simplify this further. Imagine buying a business, not a stock. You would ask, how stable is this business? How much cash does it generate? How likely is it to grow? What risks could reduce future earnings? And most importantly, how much am I paying relative to these realities? Valuation is simply translating these questions into a decision framework. Beginners often focus on ratios like PE, PB, or PS without understanding what they represent. These ratios are shortcuts, not answers. A low PE does not automatically mean cheap, and a high PE does not automatically mean expensive. A company growing slowly with high risk may deserve a low valuation. A stable company with strong cash flow and a durable moat may deserve a higher one. Context matters more than the number. One of the biggest valuation traps is comparing numbers across different businesses without understanding their nature. Comparing a bank to a technology company using the same ratio is meaningless. Their risk profiles, growth potential, and cash flow stability are different. The minority understands that valuation is relative to business quality, not absolute numbers. Another critical aspect is expectations. Price reflects collective expectations about the future. When expectations are high, even good performance may disappoint. When expectations are low, modest improvement can lead to strong returns. Valuation helps you identify where expectations are stretched. This is why great companies can be poor investments, and average companies can deliver excellent returns. The majority often ignores valuation during bull markets. Prices rise, confidence grows, and valuation is dismissed as old-fashioned. This behavior creates bubbles. The minority does not abandon valuation during excitement. They may still participate, but with awareness, controlled risk, and realistic expectations. Valuation becomes a brake, not a barrier. Valuation also protects you emotionally. When you understand what you are paying for and why, short-term price movements lose their power over you. You are less likely to panic during corrections or chase during rallies. You measure outcomes against expectations, not emotions. This emotional stability is a hidden advantage of valuation thinking. Another important point is that valuation is dynamic. It changes with price, business performance, interest rates, and risk perception. A stock can move from undervalued to fairly valued without any change in the business, simply because price moved. The minority monitors valuation continuously, not just at entry. Beginners often ask, what is the correct valuation? This is the wrong question. The right question is the current valuation favorable enough given the risks and uncertainties? Valuation is a range, not a point. If you demand precision, you will never act. If you ignore valuation, you will act recklessly. The minority operates in between. Another misconception is that valuation only matters for long-term investors. In reality, valuation influences behavior across all time frames. Overvalued assets are more sensitive to bad news. Undervalued assets often have downside protection. Even traders benefit from understanding when price is stretched relative to fundamentals or sentiment. It is also important to connect valuation with cash flow. Ultimately, Value comes from the cash a business can generate over time. Metrics based on earnings or revenue are useful, but cash flow grounds valuation in reality. This is why the minority often anchors valuation thinking around cash generation and sustainability rather than accounting figures alone. Valuation also enforces humility. It reminds you that no investment is risk-free and no growth is guaranteed. It forces you to consider downside scenarios, not just upside stories. This mindset reduces overconfidence, one of the biggest causes of failure in markets. Practically, valuation thinking starts simple. Ask, what assumptions am I making about growth, margins, and stability? What could go wrong? How much disappointment can this price absorb? You do not need complex models to answer these questions. Clear thinking beats complex math. Over time, as experience grows, valuation becomes intuitive. You develop a sense for when optimism is excessive and when pessimism is extreme. This intuition is not guesswork. It is built from repeated observation, reflection, and disciplined thinking. The minority earns this intuition through patience, not shortcuts. The purpose of valuation is not to find certainty. It is to improve decision quality. It helps you avoid obvious mistakes, manage expectations, and align price with reality. Even when valuation is imperfect, it provides a framework that protects you from emotional extremes. Remember this: markets punish those who ignore valuation during good times and those who rely on it blindly during bad times. The minority uses valuation as a guide, not a rigid rule. They combine it with business quality, risk assessment, and behavioral awareness. As you move forward, valuation thinking will become one of your strongest defenses against crowd behavior. It will not make every decision profitable, but it will reduce regret, control risk, and improve long-term outcomes. This is the quiet power of thinking simply, rationally, and independently, the core of minority thinking. In the next episodes, we will build on this foundation by connecting valuation with long-term thinking, business cycles, and ownership mindset. But it starts here. Valuation is not about numbers alone. It is about expectations, risk, and discipline. Master this, and you gain an edge that most never develop.